In early July, the U.S. Treasury yield curve, measured by the 2-year versus 10-year spread, began an inversion that brought it to negative 78 basis points at its low on November 23rd. This level represented a low not seen in over 40 years. Many traders feel that the shape of the curve represented a belief that the Fed is being over-aggressive in their hiking the short-end rates and may have to reverse course toward the end of 2023. The Fed funds futures market seems to agree with this assessment, pricing in a rate cut in Q4 2023, according to the CME FedWatch tool. The data has been confusing recently, with two marquee numbers, NFP and retail sales, coming in higher than expected, and the inflation data, measured by CPI and PPI, coming in lower than expected. The general market view of the higher than expected data was that several factors may be making the numbers look better in the short term. In NFP, full-time employment was down, and the headline contradicted the household survey, which showed a labor contraction. A similar story surrounded the retail sales data, as inflation was blamed for some of the increase, along with replacement costs after the devastation of Hurricane Ian. On Wednesday, November 30th, we hear from Federal Reserve Chairman Jay Powell as he gives a speech at the Brookings Institute. The market seems to think this could give critical insight into what the current plan is. Now, if a trader believes that the chairman's speech could cause further inversion, they could express that by buying the December micro 2-year Treasury yield futures contract at 4.41 and selling the December micro 10-year Treasury yield futures contract at 3.75. Now, this represents selling the 2s versus 10s spread at negative 66. A target for this trade will be placed at the psychological level of negative 100 with a stop above at negative 45. Now, this trade could make $340 if the target is reached and risks $210 if you're stopped at your level. Now, a reminder that when you're using multiple assets, a stop level needs to be monitored manually. Now, if a trader believes that the yield curve inversion is overdone, they could express that by selling the December micro 2-year Treasury yield futures contract at 4.41 and buying the December micro 10-year Treasury yield futures contract at 3.75. Now, this would be buying that spread at negative 66. A target for this trade can be set at negative 20 and a stop at new lows of negative 90. This trade could make $460 if the target is reached and risks $240 if you're stopped out of your level.